Nucor and Schlumberger. Tell me.
It's been a long time since we've had these old school names in the portfolio, but we're trying to de-risk into this rally a little bit. Nucor is an old school American steel company. If we believe in the infrastructure play, what better than an old school steel company to ride it? They've been increasing their dividends handsomely by 8% over the past 3 years. Really good cash on cash. And if we talk about multiple compression, and you did a great job on halftime having a conversation about multiples, it's trading at about 4 or 5.
When you say de-risk, that leads me to believe that you sold some things to move into these names. Is that right?
We did, Scott. We sold Qualcomm, and we only owned it for 2 months. We were looking at how the chips and the semis were disappointing. We sold this right before earnings, took a very small loss, reallocated into the new Nucor position, the new Schlumberger SLB position, a little bit higher multiple on Schlumberger, but just incredible cash on cash. You know, they suffered when fracking and shale was a little bit out of favor, but it seems like energy now is a license to print money. They've increased their dividend by 100% this year, and they've got a commitment, much like Devon, for up to 50% of their free cash flow to dedicate towards share buybacks and special dividends. So we like those names.
You sold Goldman too, yeah?
We did today, right before the close.
Right before the close. Why?
It's up 30% in the past month. So when we're thinking about risk managing a portfolio, and this is a great lesson for viewers, we love the stock. We still own it. But it went to a 7% weighting in our portfolio. That's too much risk to have in any one name, no matter how much we love it. So we trimmed it back to 5%. It's still a full position. We still believe in the rising interest rate play for financials. But now we've got some dry powder on the sideline for next week that we can take a look at other opportunities. So it's just risk management.
Oh, I got you. So you just trimmed it. I don't want to intimate it that you had sold the whole thing. So I'm glad you made that perfectly clear to our viewers that you still like the name. You just took the weighting down in your book a little bit. Are you a believer that this move has more to it between now and let's just say the end of the year? I don't want to even get too far out ahead of our skis, but we got, what, 6 weeks or so between now and the end. How much further do you think this goes?
Well, we think that the market's pretty fairly valued up here, but I love the seasonality and all the talk and excitement of Santa Claus and New Year's and the consumer. So it could certainly extend a little bit further, but the markets can't go up forever. Trees don't grow to the sky. And when we think about valuations for next year, I'm still in the camp that earnings estimates are going to come down for 2023, and the Fed's still going to be aggressive on that terminal rate. So we've got to be careful on our multiples and our earnings expectations for next year. But heck, into the end of the year, why not be optimistic? Yesterday was the first pleasant surprise we've had in a long time. It followed through in today. Maybe we were lucky the bond market was closed, but I'm not going to go home this weekend with any glass half full pessimism. I'm excited for the end of the year.
Yeah, I mean, do you, let's just say it does continue. Do you continue to de-risk into that, i.e. sell?
Yeah, absolutely. I mean, we'll just continue to take some profits. We're always fully invested for the most part, so it's not like we're trying to time the market. But the other thing, Scott, that we can really take advantage of in this rally, presumed rally into the end of the year, is writing calls into strain. We wrote covered calls on Cisco yesterday. We wrote covered calls on UPS yesterday. We wrote covered calls on Devon Energy on Monday. And you get a sustainable rally. You have opportunities to put a little extra cash in the portfolio, give you a little bit of buffer. Everything we own is generating dividends on top of dividends. So we're going to continue to squirrel away more and more capital to take advantage of any pullbacks. We're probably not out of the woods yet by any means. We don't have a catalyst for a full all clear bull market into 2023. But we're starting to see some decent signs, and I think there's reasons to be modestly optimistic.
Okay. Yeah, let's take some baby steps. We don't need to make these big proclamations just yet. Have a good weekend. We'll see you soon. That's Kevin Simpson, Capital Wealth Planning, joining us.